There's a gap in the mortgage market right now that has nothing to do with your client's credit score, nothing to do with their down payment, nothing to do with the Fed. It is about a quarter of a percent wide. It costs real money every single month, and almost nobody is talking about it. Let me show you where it's hiding. I'm Ron Siegel, certified liability advisor, helping families build wealth through strategic debt management. This is your weekend update for the week of July 31st, 2026. Where rates landed this week. Let's start with the numbers your clients are actually seeing. The 30-year conventional is at 6.77%. The 30-year jumbo is at 6.9%. The 30-year FHA is at 6.33%. And the 30-year VA is at 6.34%. These are national averages from Mortgage News Daily, not an offer to lend. The 10-year Treasury is still trading as we record this, so I'm giving you a live number, not a closing number. It's at 4.732% compared to 4.69% last week. That's about 4 basis points higher, and the direction matters more than the size. The spread nobody explains. Now, here's the part I promised you. Mortgage rates do not come from the Fed. They track the 10-year Treasury, and there is always a gap between the two because a mortgage carries risks a Treasury bond does not. Borrowers move, borrowers refinance, borrowers pay off early. Over the long run, that gap has averaged about 1.79%. Today, it's running at 2.04%. That's about a quarter of a percent higher than normal. Here's what that means in plain terms. If the spread simply went back to its historic average and the 10-year Treasury did not move 1 basis point, the 30-year fixed would be sitting near 6.52% instead of 6.77%. No Fed cut required, no new economic data required, just a return to normal. So why is the gap so wide? Because lenders and investors price uncertainty into every loan they buy. When the direction of rates is unclear, that gap gets wider. When the picture settles, it narrows. The gap is one of the quietest opportunities in this market, and it is worth understanding before you tell a client to wait. The Fed did nothing, and 3 members objected. The Fed met on July 28th and 29th and held rates where they were. That was expected. What was not expected was 3 dissenting votes. Beth Hammack of the Cleveland Fed said inflation has been too high for too long. Fair enough. But in the same set of comments, she said demand was too strong and then said people are struggling and cannot buy things. Those 2 ideas do not live in the same house. She also called the labor market stable without mentioning that private payroll readings have softened for several months in a row. Neil Kashkari, the Minneapolis Fed, was more measured. His concern is that we have had one supply shock after another. First Ukraine, then trade disputes, and now Iran. He normally favors looking past shocks like these. His worry is that when they stack up back to back, higher prices start to feel permanent. The inflation data is better than the headlines suggest. Here's what the actual report said. June core PCE, the Fed's preferred inflation measure, rose 0.1% for the month. The forecast was 0.2%. Unrounded, it was the smallest monthly increase in 15 months. The 3-month annualized pace came in at 2.89%, the first reading below 3% all year. Year-over-year core is still 3.29%, which is too high, and that is the number the Fed keeps staring at. Shelter, which has been the stubborn piece of the puzzle for 2 full years, rose just 0.2% for the month. That is the reading a lot of us have been waiting on. The Dallas Fed trimmed mean, a measure that strips out the one-off swings in both directions, came in at 2.2%. Last month, it was 2.4%. The Fed's target, 2%. And one more piece that has not shown up yet. Starting with the August report, the way portfolio management fees get counted inside PCE is being adjusted. Those fees have been adding about 0.4% to the year-over-year core reading. We will not see the effect until September, but when it lands, it could move core down from 3.3% down toward 2.9%. Growth, jobs, and the consumer. Second quarter GDP came in at 1.5%, down from 2.1% in the first quarter. That headline looks soft, but the internals were better than the number suggests. The drag came from lower government spending and higher imports. Strip out the noisy pieces, and private demand grew at 3.9% annual pace. The catch is, who's doing that spending? Personal income rose 0.2% in June. Spending rose 0.3%. When you spend more than you earn, something has to give, and it did. The savings rate fell to 2.7%. Jobless claims are still low. First-time filings rose by 9,000 to 197,000. Continuing claims fell by 7,000 and are sitting near 1.8 million. Employment costs rose 0.9% in the second quarter, which annualizes to about 3.6%. Wages are not what is driving inflation here. Oil, Japan, and the rate outlook. Two things pushed against us this week. Oil is trading at $85.78 a barrel as we record this, after sitting around $68 in June. That is a move of nearly $18 in about 6 weeks, and it feeds straight into the inflation numbers we get later this year. U.S. crude inventories, including the Strategic Reserve, are now at their lowest level since 1984. Japan also stepped in to defend its currency, and that selling spilled into the Treasury market overnight. So what is the outlook from here? The 10-year yield is stuck in a range roughly between 4.2% and 4.8%. At 4.732%, we are sitting near the top of that range, not the bottom. A real de-escalation in the Middle East would knock oil lower and pull yields down with it. The same is true for Ukraine. Until then, expect big swings in both directions over the next few months. This is not a market that drifts, it jumps. Featured for our partners this week, we have a full set of resources on the dashboard for you this week. Here are the ones I want to point out to you. Number 1, 4 ways to turn your home equity into cash. Pick the wrong one, and it costs you. Number 2, the home buying costs nobody warns you about until the bills start arriving. Number 3, the best colleges don't rank themselves. Why do you let them rank you? And finally, number 4, your business is growing, but your money isn't. 10 mid-year fixes that protect profit. There are several more on the dashboard beyond these 4. All of them are available on the right side of your dashboard or below the video, depending on the device you are using. When the tax return does not tell the whole story, we keep a selection of loan programs for the borrower whose tax returns do not show the full picture of their ability to borrow and repay successfully. That describes more of your clients than you think. Here's the one I want to highlight this week. Employers everywhere, and hospitals in particular, are moving their people from W-2 to 1099. Same job, same desk, same paycheck. Then the person applies for a mortgage and the bank says, wait 2 years. They do not have to wait 2 years. I break down the loan that solves this, and it is available right now. The details are at rsrlinks.com/W2-1099. That's rsrlinks.com/W2-1099. If you know a nurse, a physician, a therapist, a technician who got the letter this year, that link is the whole conversation. Strategy beats rate always. And our one more tool, Debt Done Date. One more tool for you, and this one is free to share. It's called the Debt Done Date, and you'll find it at rsrlinks.com/DDD. That's rsrlinks.com/DDD. Your client enters every debt they carry. Mortgage, auto loans, student loans, credit cards, and unsecured debt. We then show them several different ways to strategically pay all of it off, and the date each path gets them to zero. Most people have never seen their debt laid out on a single page with a finish line attached to it. It changes the conversation. Send it to a client this weekend and watch what comes back. Next week on the calendar, next week is Jobs Week, and it is a busy one. Now, all these times I'm telling you are Pacific time. Monday brings ISM manufacturing at 7 a.m. along with construction spending. Tuesday brings JOLTS job openings at 7 a.m. The prior reading was 7.59 million. Wednesday brings ADP private payrolls at 5:15 a.m. with 98,000 the prior month, followed by ISM services at 7 a.m. Thursday brings jobless claims, Challenger layoffs at 5:30 and Challenger layoffs at 5:30 a.m. And Friday's the big one, the July jobs report at 5:30 a.m. The forecast is 91,000 jobs, up from 57,000 jobs last month, with the unemployment rate expected to tick up from 4.2% to 4.3%. Average hourly earnings come out at the same time. If those numbers come in soft, the bond market will notice. Everything I mentioned today, the featured articles, the loan programs, and the tools, is on the right side of your dashboard or below the video, depending on the device you're using. That's the weekend update. We appreciate you listening and watching, and we will speak to you again next week.